Good afternoon, everybody. Whether you're dialing in from South Africa, the UK, or any other far corner of the earth, thanks for joining us today for the second quarter update of our Nedgroup Investments Global Diversified Equity Fund. Before we get started, you'll notice that I have my headset on. My neighbor decided that today was a good day to invite every major South African construction company over for his kitchen renovations, so I do apologize in advance for any background noise. My name is David Levinson, and I'm an investment analyst on the best of breed team here at Nedgroup Investments. And I'm very pleased to have Jeremy Lang on the line from London. Jeremy is CIO at Ardevora Asset Management and Portfolio Manager of our Global Diversified Equity Fund. Jeremy, just to check that you can hear me loud and clear, and thanks for joining us today.
Thanks, David. Yeah, you're loud and clear for me.
Brilliant, thank you.
Kick off?
I'm just going to do some quick housekeeping, Jeremy, before we get started. So just for the audience that have dialed in, as per usual, there's a Q&A function on the right-hand side of your screens. So please do feel free to ask any questions, which I'll then pose to Jeremy at the back end of the presentation. And as per usual, if you have dialed in via your phone as anonymous for reasons of CPD points, please type your name in the Q&A section so our team can get your details on record. Again, before I hand over to Jeremy, a brief observation from my side. Back in June last year, we were very excited to begin our partnership with Ardevora. So this is in essence our one-year anniversary update. Since inception, the fund has served our investors well. Jeremy will touch a little more on some of the numbers, but for our South African investors, it's worthy to mention that the fund has ranked in the top quartile across all major time periods since inception. So that's being the 3, 6-month and 12-month numbers. For those of you who are familiar with Ardevora and their approach to investing, and those who joined us for the 3-part series on human behavior with Neil Beige a few weeks ago, I'm sure you'll find today's presentation interesting. And for those that have not come across the fund before, I hope this may perk your interest in what I believe, and I stand to be corrected here, is the only behavior finance style fund on offer in South Africa. At this point, I'd like to hand over to Jeremy. Thanks, Jeremy.
Thanks, David. I'll take 15 minutes to introduce the business, very quickly remind you how we pick stocks, and update you on how things have gone so far this year, which has been an exciting year. So if we could flip to slide 2. The business, we're Ardevora, we're privately owned, a boutique. We have just over 6 billion sterling in AUM for clients all around the world, obviously including South Africa. We launched the business in 2010, and today we remain a private partnership as we were when we started. We do things our own way, which is the benefit of being private and wholly owned, and we're fairly modest in our ambitions. If we could move to slide 3. Okay, so moving on to how the fund is built. It's a long-only global equity fund with a bottom-up fundamental process. We're a little bit different to others in that we focus on psychology and we're essentially interested in why other people make mistakes, including us. In particular, we think CEOs can be very risky. That is, unless they face environments that encourage them to be sensible. I won't get caught up too much in the details of our stock selection process because we don't have a lot of time, but I'll just try and paint a picture at the sort of high level, because all the little intricate things that we do essentially end up with 2 generic types of investment opportunities. One is an unusual growth business. Most CEOs, we think, view their businesses as growth businesses, but for us what makes it unusual is that it'll have some kind of business model, and also it'll operate in some kind of unusual environment where it's just unusually easy for them to grow. Often analysts can be more interested in what the growth rate is rather than how easy it is or for how long it goes on for, and that's often how we can then get an opportunity to make money out of those unusual businesses. The second type is a safe value business. Most CEOs, in our view, like taking risks and they don't like being wrong, but occasionally if they're wrong for long enough, enough pressure can build on them to change, and they can be coerced into something which they don't normally like to do, which is to de-risk their businesses. And often that can happen at a time when investors have been traumatized during that period of bad behavior, and they don't then trust the recovery plan. And so that's the other kind of environment where we think you can make some money. What do clients end up with? Well, because we're aware of our own tendency to make mistakes, we like having lots and lots of small positions, and we like being as diversified as possible by style, by sector, and we don't like taking big bets. We don't like taking big regional bets, and we don't have favorite stocks. The downside and upside numbers are generally what kind of hooks our clients and makes them interested in us. They're quite good, as we'll show you in a table a bit later. And it's also our ability to be, I would say, fairly pragmatic and contrarian, which allows us to perform in most types of market regimes. And you'll see this in the performance slides coming up. We'll move to slide 4. Oh, there it is, the pretty performance chart. You can see from the line chart that we launched this particular strategy in 2013, and it's delivered a pretty reasonable performance. I'd just like to mention the recent performance of the fund, which is shown on that left-hand part of the boxes underneath the line chart. And from that, hopefully you can see that we've coped pretty well with some recent wild market moves. We've been able to provide some decent downside protection year to date, but also we've been able to participate in some of these fairly violent market rallies as well. Longer term, if you look at those 3 and 5 year annualized numbers, you can see that we don't sacrifice upside capture in our pursuit of offering some downside protection. Slide 5. Key performance contributors. So we've got a little list there of the top and bottom performers for the quarter, and so that gives an opportunity to talk about a little bit about the environment, and then a bit later go through maybe a couple of examples. So environment we faced this year, well, I think it's fair to say it's been a pretty unusual environment. In terms of the kind of the key behavioural blocks that we're interested in, which are CEOs and analysts, CEOs have faced probably one of the first most serious macro shocks they've ever experienced, or certainly something which is they haven't experienced since 2008. But the shape of that shock has been quite unique. As a result, CEO behaviour has changed a lot since the start of the year. A lot of pressure has been exerted on what were many of them, whether they were pretty relaxed and risk-loving at the start of the year. And so there's been a lot of CEO change in behaviour, I would say. It's taken a little time because when things started to change, normally CEOs are resistant to change, but the shock has been so deep that now an unusually large number of them are focused on how basically to reduce risk and improve the robustness of their businesses. And that's pretty unusual in our experience. For investors and analysts, again, like CEOs at the start of the year, they were pretty relaxed, but they have suffered a lot of trauma in the last 6 months. And in our view, anxiety still remains high, and the unusually deep shock that we've experienced tends to leave scars, which can keep anxiety lingering for many years. However, we're pretty sure that peak anxiety has now passed. If you take a look at the table, I'll just highlight a couple of the points before talking through some of the examples. You'll see that in that attribution stuff, the PF weight column shows the proportion that each stock represents in the portfolio. So what you'll see there is we've got lots and lots of small bets. The excess return contribution column shows that our biggest winners contribute only about 0.5% of our performance in the quarter. And so what you can take away from this is that, well, first of all, I was warned not to try and make this too boring because it's a sleepy time of the day, but people don't normally die of excitement when they read our quarterly reports. We don't rely on a couple of big winners to deliver our performance, and we think this makes us more robust and more consistent, but it doesn't make for a particularly exciting story. Now, in the interest of time, I'll give you a quick snapshot of a stock that did well and a stock that did badly in terms of that attribution. One that did well, I'll pick the top of the pops one, Thor Industries. It's by far the largest maker of recreational vehicles in the US and actually in the world. It's the largest because it's gradually hoovered up most of the competition. Selling RVs isn't an easy thing to do because demand can be pretty unpredictable. Also, before Thor got stuck into all its M&A, the industry was pretty fragmented and it was prone to a lot of price competition. Now Thor has gone has done a lot to improve the behaviour of the industry and has been run with an eye more on efficiency and risk than growth. Now, there was a lot of anxiety about what Thor did a few months ago, because it sold big ticket expensive RVs when COVID started to rip through the system, and investors worried that everybody would stop buying RVs. And so there's a lot of anxiety, but this anxiety has already started to unwind quite considerably, as people have worked out that demand won't disappear forever. And Thor, in the meantime, has just continued to do what it has done for a number of years, which is just to operate in a sensible, low-risk way. So we've reaped the benefits, I think, of that anxiety unwind already. One of the actually our worst contributor was a stock that we own. In fact, the top 4 are stocks that we own. Microsoft. We like Microsoft. We own it. But it's our biggest detractor, and that reveals, if you like, one of the downsides of our approaches, because we equally weight all of our positions. We think this makes it easier for us to admit our mistakes and makes for a less risky overall portfolio. But sometimes when a few large stocks do especially well, it can make us look a bit dull versus market cap weighted benchmarks. But my experience is it generally swings and roundabouts for these things, and also our clients generally don't like paying us active fund management fees for tying up a whole bunch of money in large market cap weighted positions. So I'm pretty relaxed about that as a large detractor. Okay, right. I'll wrap up here. I guess if you can take away just a few things for this, I'd say, as probably all of us say, we think we're unusual. We don't trust company management unless the environment they face encourages sensible behaviour. Our process allows for both safe growth stocks and safe value stocks, and we don't make big bets. Okay, Dave, back over to you for some questions. Oh, sorry, you can skip that slide.
Tells very brief. Slide there. I don't know if we've lost Jeremy there. Jeremy,
yeah, no, I'm still here. I just couldn't hear you for a moment, David. So,
apologies. I've just gone to the slide showing the tilt between your value and your growth stocks, and we have had a question come in on this already. So, I mean, just looking at that chart for the first time, I think since about end of 2014, there's a tilt in favour of the value, or the de-risking value, as you refer to it. And we did have a question come through here saying, have you seen a shift in the allocation between value and growth, which we are seeing here over the past 6 months? And is this by your own intention and design, or is it more the fact on what the market has done and brought more stocks into your sample on the value side?
Yeah, so the answer to that sort of two-headed question is kind of yes and a bit of both. So so yes, we have shifted the mix a lot, as that chart shows. And we've shifted it partly because we've reacted, if you like, to what has changed from the start of the year, and indeed what we've kind of seen for the last 5 years, versus what we saw, if you like, in the peak of the ramp up of the COVID pandemic. So the key thing that gets us interested in having more, if you like, value stocks versus growth stocks, it's a two-pronged thing. First is we like to see plenty of evidence of generally lots of investor anxiety, because we think it's easier for investors to overreact and get too anxious when lots of them are doing it at the same time. So when you get an unusual macro shock, I think it makes it easier for investors to get too gloomy generally. So that's the first side. That creates potentially more opportunity. But the second side, which is the safe value stock bit of what we do, is also the CEO behavior has to be sensible as well. And that is where, again, if I go back to that little comparison I did in the presentation, at the start of the year, our feeling was that there were plenty of businesses that were struggling, and that the CEOs that ran them were in denial about that. And they were too relaxed, if you like, about the problems those business faces. That has changed a lot. So there have been many businesses which have been chugging along in a reasonable way before the pandemic hit, where the shock of the pandemic and the depth of it has suddenly changed CEO behavior and made them much more risk averse. And that's what we like in those kinds of stock opportunities. We like to see change in management behavior, so it's much more risk averse at a time where, if you like, the opposite happens with investors, where they go from being relaxed to being extremely nervous. And I would say that's a kind of characteristic of where we are now.
Okay, thanks there, Jeremy. Another question here, which I guess ties into CEO behavior, and it also speaks a little bit to your top detractors for the quarter. Holding companies like your FANG, so your Facebook, Apple, Amazon, is it Netflix, Google, or Alphabet? The question here is, as the FANGs continue to grow and we see their balance sheets expand, are we beginning to see a change in CEO behavior? And if not, is this a concern?
Okay, so the FANGs are a very interesting group. Now, in terms of CEO behavior, now what normally happens with traditional businesses is that the longer they do well, the more tempted they get to strain for growth and try and keep growing for longer than they should. The FANGs are a little bit different. They were previously built for growth, and they were unconcerned about things like profit and cash flow during their high growth phases. But as we sit here today, they vary a bit, but they've begun to be very successful at, if you like, monetizing that growth. So they've been prepared to accept slower growth, but much better free cash flow and much better profitability and much better pricing power. So they're following a path which is slightly different to the normal pattern and cycle of growth stocks which start to go ex-growth. Now, they face a slightly different issue, which is less to do with that. As their balance sheets build up, they find it harder to grow, and they're tempted to do reckless things. Actually, I think the problems they potentially face, which they don't face right now but will come, is from the regulator, because they are just beginning to exert pricing power on some of the things that they do and to start making more money out of what they do. And they have the capability to earn a lot of money from what they do, but that's going to attract some regulatory scrutiny at some stage.
Excellent. Thank you, Jeremy. And then moving on, we've had a couple of questions come through on banks. You've typically been underweight financials, and I think to quote one of your colleagues, you find the businesses rather peak to assess. So the second part of this question is US financial stocks are the second worst sector, I think in the last quarter or the year to date at least. It's a sector you have avoided, but is it growing in attraction to you, and have more bank stocks fallen on your screens recently?
The short answer is no. As you know, we don't trust CEOs, and then there are certain businesses that we don't trust as well, and banks are one of them, I'm afraid, even though I know you guys are banks. And so when I fold the two together, it's too toxic a combination for us. We'd rather just kind of avoid them, and that's more from our experience that when things go wrong with banks, you generally don't see it until it's too late. So it's an area where we've just stayed away from for really since we launched the fund. We think there are plenty of other ways of playing investor anxiety at the moment.
Okay, thanks, Jeremy. And then quite a fun question we've been asked here. I think people are quite curious with regards to your mistrust of management, and the question here is, what are your views or your insight on someone like Elon Musk and their behavior as CEO?
We wouldn't back him. I mean, he has a very interesting business, but the pattern of behavior that he follows is just too risky for us. So he's too much like a sociopath. So no thanks.
I think that's probably where the question was going, whether you viewed him on the sociopathic spectrum or not. And another question here, can you give us a few stock examples of some of the more recent buys or opportunities you have made in each of the categories? So I know you've added quite a few stocks recently. Maybe you can talk to one or two of those. Yeah,
so I'll give you two examples which are kind of they're good because they show you how eclectic we can be. So we've bought almost the two extremes of the market recently. So we've been tempted into areas which we've not had an investment in for some time, which are areas which are causing particular anxiety at the moment, which is in the leisure and travel industry. We bought, and these are predominantly actually skewed to Europe. So we've bought a few things which are tied to air travel and to leisure, of which probably the most extreme example is something like Carnival Cruise, where what unifies them all is this sense that when you think about them a year ago, they appeared to be perfectly sensible businesses with plenty of growth and were run reasonably well. But when you look at them now, the overwhelming narrative, which crowds out all other things, is the idea that COVID changes everything. And our experience is when you get such a swing into such a simple kind of reason where instinctively you don't want to own them, there's a reasonable chance that that people have overreacted. At the same time, those businesses have been hit so hard in the short term, they're making extraordinary efforts to de-risk their businesses and try and survive. So we've been attracted into that area. At the other extreme, we bought a few software stocks in the US, which video gaming stocks, where the kind of unique aspect of this shock and the kind of forcing of people to stay at home has suddenly made life a lot easier for them and accelerated some of the trends that were already favourable for them and made growth a lot easier. So this is one of the peculiarities about this crisis, is that it creates both extreme anxiety on the one hand, but also new opportunity on the other.
Yeah. On talking about anxiety, I think you mentioned at the end of Q1 around the expectations of peak anxiety, and you mentioned earlier in the presentation you think we may have reached there. Have you been surprised at the speed of the recovery in the last quarter?
I've been surprised at everything. We were, including ourselves, we were very, very gloomy about things in February, and one of the reasons why the performance of the fund has been reasonably good this year is that we were fairly conservatively positioned at the start of the year, but not obviously because we saw this shock coming, but we were just of a frame of mind, partly because of how well everything had done the previous year, that it was right to be a bit more cautious. And then as this all hit, we were very gloomy as we saw the initial signs of the shock rip through China, which made us reduce risk a bit more, but we had no idea how bad it was going to be. And as the momentum built, we got very gloomy. And then we got convinced ourselves that it was going to be really, really bad. And then the market started to rally. And that forced us to think about things, from lots of different angles. And it's after a few weeks, that's then when we thought, this is kind of interesting, because there's a whole group of stocks in the market where views are very extreme, and also big macro shock going through. And all our experiences told us that this is the time where you really want to be trying to buy other investors' anxiety, even if it feels really uncomfortable yourself. So we've gone through a huge swing ourselves, and of course the whole speed of it has added an extra dimension. So you've had to have been quite nimble to navigate through it.
Yeah, I like that term nimble, and I think you mentioned, was it in Q1 you started trimming some of your oil stocks in light of what was happening on the OPEC front and just geopolitical risks. Have you started adding again, and how are analysts looking at oil stocks in your view at the moment?
No, we've binned them all actually, and again we see better ways of playing the anxiety unwind, because there are just so many layers of risk in the oil industry at the moment. Not only what OPEC does, but also there's lots of stranded capital in the oil industry, and then there's the whole ESG angle as well. So I just think there are better risk-reward ways of playing this kind of pile up of anxiety, and then release again as the economy gets back and starts to grow again.
Okay, thanks, Jeremy. I'm glad you mentioned ESG there. We have had a question come through regarding sustainability. So the current surge, or at least concentration on sustainability issues, is this causing you to change your approach, in the sense that are management teams now less likely to create problems within these constraints of sustainability?
The answer to that is it really varies. We've done a lot of thinking about ESG in the last couple of years, and it's many of the things are aligned with our cynicism about management anyway. And so many of the things that we think are bad and risky CEO behavior, often you can see them because they're fairly reckless on the ESG parameters as well. But there are a few activities which we've decided that it doesn't matter how well or badly a CEO behaves, the ESG risk just doesn't make sense. And that conclusion was also one of the reasons why we decided to completely evacuate from carbon-based extraction industries, because we just can't see how they can possibly make sense if you're interested in the wider ramifications of what they do. But to get back to your question, sorry. Also, when a business is under a lot of financial stress, sometimes they can throw the ESG things out the window because they're more worried about surviving, and they can maybe deprioritize some of the things that they ought to do. So it doesn't always help you. So yeah, you have to pick your way through it carefully, I would say.
Okay, thanks, Jeremy. And then you touched on, in one of the earlier slides, you don't like to focus too much on the macro. I think it's very notoriously difficult to make assumptions and calls on where macroeconomic conditions may be going. But we've had a question come in here regarding the Fed. And are the Fed's actions and behavior in the market starting to grow in importance in your process?
No, because the Fed and central banks' behavior generally is always occasionally important. It's the key thing here. So our view on them is that you go through long periods where, at a kind of basic stock selection point of view, what they do doesn't matter very much, but then very occasionally it matters a lot. And so we're in 2008 was the last period, and we're in one of those now, and they become relevant because, if you like, without them, it might be right to have an extremely pessimistic and anxious view on the outlook for lots of businesses, but when they suddenly loom large, it changes the rules of the game, and it means you have to check, if you like, how right it is to be quite so anxious, because they act kind of like a safety net. So you don't have to, if you like, get into debates about predicting whether what they're doing is right or wrong, or whether it'll work or not. It's just simply just that flag goes up that they're doing a lot, and generally it's not right to be prone to be too anxious when that happens.
Okay, thank you very much. And then probably the final question, due to time constraints we have here, is, so you mentioned already that you're quite cautious at the beginning of the year, which has served you quite well. How does the cautious view at the beginning of the year affect your approach to portfolio construction, in the sense that how do you make adjustments if you are bottom up?
We do it through the mix of the types of stocks that we own, and in particular, actually, it's more that exposure to value stocks. So if we get more nervous about things, we tend to wind back towards, I would say, sort of safer, low, sort of middle-ish growth stocks, because we have quite a lot of choice, if you like, within those two buckets. And then as we get more interested, we can sort of wind that risk back up again. So it all kind of goes through that sort of mix of the types of stocks within the various buckets that we choose, where we want to go, if you like.
Okay, thank you very much, Jeremy. I think that's all we have time for. For us, the 3 parts. Sorry, I think I dropped off the call there. Am I back?
Yep, you're back.
Oh, okay. Sorry, I might have cut off. I'm not too sure at what point, but we hosted a gentleman by the name of Neil Beige who did a 3-part series for us on human behavior and psychology and rational thinking. And you'll be chuffed to hear he covered quite a few of the biases which you guys have adopted internally. So anchoring, closeness, confirmation bias. So I know it perked a lot of interest in our clients. And as I said at the beginning of the call, I think this is probably the only behavioral finance of style fund in South Africa. So should anyone on the call have any further questions, please do get in touch with your Nedgroup Investments relationship manager, and we'll happily furnish you with some more information on the fund and the investment style at Ardevora. So, Jeremy, thanks for joining us today.
Thanks, David.
Thank you. Really appreciate that. Just to close off, I'm afraid that's all we do have time for. We have reached our 30-minute limit today. But please do join us again tomorrow at 10 a.m. where we will be reporting on the Global Property Fund. And then in the afternoon, my colleague Neil will be chatting on the Global Emerging Market Fund. So again, from myself and Jeremy and my colleagues at Nedgroup Investments, thanks for joining us today.